Welcome to the What to Watch video update. This is the last weekend video that I do where I pull out those charts, positive, negative, and those things that we're just keeping an eye on to see if we can get some insight as to what's happening and what I'll be watching, at least at the beginning of this week. And this week we're asking the question, will domestic and geopolitical unrest cause the S&P 500 to decline? And this is being prepared for Monday, June 16th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First of all, we'll go through the positive side here. We're still looking okay, even though this is showing some weakness. We like this better when the blue line is above the red line. This is an intraday chart of growth to value with the large caps. And as we were coming up out of the April lows, we saw that they would switch back and forth. But eventually, we saw the blue line going above the red line, and that's more positive. Well, they're both drifting down. We had a down day on Friday. And that's why we're asking this question. There's a lot of things happening geopolitically between Israel, Iran. There's a lot of things happening in the U.S. with the riots and demonstrations. So is that going to be enough to really push prices down and actually change the overall climate in the market? Then this is still looking okay. It's flattening out since we hit June here. This is an intraday chart of growth versus value for the S&P. This was really improving as we were coming up out of the April lows, and we've kind of leveled off here, but we haven't turned negative. We have up days and down days, but it's still hanging in there for the most part. And even though we're pulling back here in the short term, we're a little bit below the fluorescent green moving average here, which is a 10-period simple moving average. The line is still going up for right now, and if we can bounce back up from here and resume the upward trend, it would see all of these lines continue to go up. Now, are we going to continue to come down? That might put these lines that have been going up in danger of starting to roll over. Then we look at the condition of the short-term trend. Even though we're below both of the lines here, the green line and the blue line, we're rolling over just a little bit, but we haven't really started to turn negative on this chart, but we're watching this. If there's any more weakness, this may, in fact, turn negative. We're still looking okay with the intermediate term trend. However, for the first time since we've been really coming up out of these lows, this red line has been acting as a level of support. In Friday's session, we dropped below the red line. So for right now, it's still looking positive, but if we see more weakness and we see this red line start to roll over, that could pose a threat to the intermediate term trend based on 50 periods. We're still doing okay with our moving averages. And if you look at the overall pattern here, and I've been pointing this out in all the videos, ever since we came down to the 200-day moving average and bounced up off of that, and you could even take it back to coming up out of the lows. But more recently, we're seeing, for the most part, a series of higher highs and higher lows as we've been coming up. Is that about ready to change? We did hit overhead resistance on Wednesday. That was a pivot point that we hit that we knew about ahead of time, and I update those on the YouTube community tab every day. And since that time, we've been coming down. Even though we had an update on Thursday, we gapped lower and ended up closing just off the low on Friday. And even with the pullback in Friday's session, we're still above all of the anchored moving averages here. And these are, they use their reference point. A lot of them are previous lows. We have one up here that goes back to the all-time high. And as long as we stay above these lines, this could produce a lot of support. And the more we stay above these lines, the more the lines continue to go up themselves. And we're still looking okay here with our growth to value ratio here. Even though we declined on Friday, we're still above the majority of the rainbow. We're still looking okay with small cap growth to value and mid cap growth to value. And S&P growth to value. It did get hit, but we spent enough time above these moving averages that we just generated a recent golden cross here, and that is suggesting that growth is outperforming value on a trend basis, and that's more positive for the market. We look at our growth to value ratios, pulling back, but still above an advancing moving average with the Qs to S&P. Discretionary to S&P, this is where we're seeing some weakness. And I'll point that out in other charts here. We need discretionary to do a little bit better job. And that includes Tesla and Amazon, or the real big companies in that sector, where we're still looking okay when we compare large cap growth to large cap value. Starting to drop a little bit below the moving average now, with large caps coming down, but still above the moving average with the mid caps, and bouncing up off of the moving average with the small caps. And here's discretionary again. Now, this is an equal weight ETF where the discretionary sector itself is weighted. That means that Tesla and Amazon count for a huge part of the movement of that sector. To try to make it a little more fair, we look at an equal weight version of discretionary, which is not doing all that well in and of itself. Staples have been pretty much going sideways, but that's causing our ratio to come down. Now we're still positive because technically we're above both of the moving averages, even though this is still in a downtrend. We bounced up off of this moving average here. That's a 200 period moving average of this ratio. Are we going to be able to bounce up off of that again? If we fall down below these lines, that will turn things more negative. And then we look at a value to tech ratio, kind of a reverse of what I was just talking about. And the fact that this ratio is still going down, that is positive for the market. And we were looking really solid here with the 10-day average of the highs and lows for the S&P. We got above the green line. Now we are pulling back, but I'm still keeping this positive because we're getting quite a high reading. But the context is in the shorter term, we are seeing some weakness. If we continue to fall down here, that would suggest that there's more internal weakness developing inside the S&P that's longer term. We look at a 50 period moving average of the new highs minus the new lows. We're still going up. We crossed back above zero and we continue to show some improvement here. And even though we declined on Friday, those stocks inside the S&P above their 50 period simple moving average, we're still above 50 with the 50 period moving average study and the 100, and it declined as well. And for the most part, we've been improving with our risk on to risk off ratio. It fell on Friday, but if this could continue to go up, that would be more positive. And our high beta to low beta, when this is going up, that's more positive for the market, even though it fell back with everything else on Friday. And we're seeing a little bit of weakness shorter term with the advanced decline line, but we're still above these advancing moving averages based on price and volume. That's positive. And we're declining, but still above zero with our advanced decline oscillator. And now there's a couple of different ways to look at this chart. This is a smart money indicator, and we're still above the advancing red line. That's a moving average. So that would make this positive. But the boom indicator is more shorter term, and it's been just chopping along this red line. Well, with Friday's downward move, in the shorter term, this is looking more negative, where in the bigger picture, we're still looking positive. And we did see an improvement, even with the down day on Friday with the vortex. The green line went up and the red line came down. So it picked up some strength that it likes. But we're not trending. And here's the short-term ADX. We are positive with the green line above the red line, even though the green line's coming down and the red line's coming up. We're below the moving average and we're below 20. That means we're not trending. Then we're seeing that same thing here in the intermediate term. Positive with the green line above the red line, but we're dropping back below the moving average again, and we're below 20. And then this is positive again. You can see the series of higher highs and higher lows, even with Friday's decline. Now, if we break this, if we continue to come down, that would be more negative. Now, when I said we hit the high on Wednesday, that was this dashed line up here that was already on the chart. It's a pivot point. We came right up to that level, which was at about 6,050, and we hit that. And then Thursday and Friday, we spent coming back down. Is this going to point to some kind of a reversal? We don't know that yet. We're just going to be watching to see how it plays out. And then on the bottom, we continue to be below average with volume. If we do continue to fall, we're still looking positive with the short-term trend, but we might find some support at the 20-period moving average. When we declined back in May, we were able to come down to this moving average. It was like a conglomeration of a bunch of moving averages coming together and then bounce up off of that. Are we going to come down and test this? If we fall down below it, that's going to turn the short-term trend over to negative. But for right now, it's still positive. Here is a look at the short-term rainbow. We are coming into the top end of the rainbow, but all of the lines are still going up, so that's positive. Intermediate term rainbow, we're above all the lines plotted here, even though we're seeing the declines from Friday, but the shorter term lines are starting to turn back up. And we're also above all of the lines with the long-term rainbow. So this is still holding up for right now. We are positive with the parabolic SAR daily chart with the dot underneath, and we're positive with the weekly chart. The dot is underneath as well. And even though we had a down week, we're still looking pretty good. Now you notice the chart pattern that I showed on the daily side. We're seeing a similar thing here on the weekly side. Each one of these bars is 1 week. And for the most part, we are seeing a series of higher highs and higher lows as we've been coming up out of this. We still haven't gone back to the all-time high yet. We're not all that far away from it. And we might give a test to that at some point. And then if we do go up, what's going to happen? Are we going to hit this and then come back down? Are we going to be able to set a new all-time high? Even though we declined in Friday's session, we're still above the moving averages with the NYSE common stock, S&P mid caps, and small caps. And we're still above zero with the 5-period moving average of the highs and lows. And this is a broader market measure. It goes across the Amex, NASDAQ, and NYSE. And this is improving. And we're still above the 200-day moving average with the Wilshire 5000, as well as the total U.S. stock ETF. These are two broad market measures that we follow, and they're still holding up for the most part. We're in a downtrend with the NASDAQ, but we came almost up to this R1 pivot point, and we've been coming back down. But we're above both of the moving averages here. That's why I have it as positive, since they're above these moving averages. Seeing a very similar pattern here with the NASDAQ 100. Downtrend, but above the moving averages. Now, the financial sector, it held up better. It got hit with everything else when we went down in March and into April, but it came back above the moving averages. And the 50-period moving average is still further above the 200-day moving average, where we're seeing downtrends with a lot of the indexes that we follow. That's the positive side. The negative side, and I wanted to keep these charts together, we're starting to see the financial sector really underperforming the S&P. We've come all the way down to this 200-day moving average with this ratio. If we fall down below this, now we're not seeing really any warning signs in the other charts that we look at to see how is the financial sector doing. But this is a little bit of a concern. It might just be a pullback that we can bounce up out of, or if we fall down below this, that's going to be more negative, and we'll be focusing more on that. The FANG index just coming off of setting a series of all-time highs and in an uptrend. These are the really big stocks, and that's healthy for the market. The semi to tech ratio. Now I have it positive because we have been showing some real improvement, even though it did decline here in the most recent reading. And we're still looking okay with our stock to bond ratio. We're still above the majority of the rainbow, suggesting that the market thinks we're going to have a soft landing, which means no recession. Now, if we start to fall back down into the rainbow and drop down below it, that would suggest that we may go into a hard landing. The staples to tech ratio, for the most part, continues to decline, and that's positive for the market. And the staples to S&P ratio is, for the most part, declining, and that is positive. The S&P to utilities ratio is going up for the most part, even though it declined on Friday, but that's positive. And we're looking positive with our Qs, which is growth to small cap ratio. This continues to be above the blue line here. So that's holding up. And our growth to value ratio between the NASDAQ 100 and the Dow continues to go up as well. And this is positive since we've been going up with the NASDAQ 100, but now I drew this trend line on here, so it's not an exact science. I have to eyeball this, but we're just coming up close to the underside of this long-term trend line going back to 2009. If we do go up and hit that, are we going to be able to break through it, or is that going to provide overhead resistance? Or have we got close enough to this trend line and now we might start to decline from here? Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now the negative side. Since we had a down week, we were positive until we went into Friday's session, but we were looking, just kind of chopping along, looking better and better as we were going up. We hit the high on Wednesday. That was around the 6,050 level, and that was pretty much it. We tried to go back up a couple of times, but we saw some weakness come in on Wednesday. We held up okay on Thursday, but we just kind of chopped along sideways. And then everything broke right before or during the night before the market opened on Friday between Israel and Iran. We gapped lower. We came right down to the 59.75 level. And then the buy the dip folks tried to come in and push us up and did a pretty good job. Got us all the way back up to 6,025. But then the smart money came in. They usually take place later in the day. They came in and decided to sell. We broke down below the 59.75 level, chopped sideways. We did bounce up a little bit off of that when we were going into the close, but this is a little bit more negative, and we want to watch the futures as they open Sunday evening to see is there going to be much of a change? Are they going to be positive or negative as it gets a chance to react to what's happening over the weekend? Now, this is on the negative side because we were seeing an improvement with sentiment, but now we're starting to come back down here. So that's why it's over on the negative side. And we're negative with the VIX because we crossed back above 20, both with the line chart and with the bar chart. And we're seeing some weakness coming in here. We're seeing a contraction of the new highs as the S&P had been going up. That's a bit of a negative divergence. And it's enough so that our 5-period moving average is now going down, and we're starting to slightly go down with our 10-day moving average. And it's not so much that we're seeing a big expansion of new lows, although there was a few on Friday. It's more of a contraction of the new highs. And in the short term with the advanced decline ratio, that's the blue line, we crossed slightly below zero, but we're still above zero with the intermediate term advanced decline ratio. And we dropped below zero with the S&P McClellan oscillator. So that's turning this negative, and we're starting to go down with the summation index based on price and volume. That's negative. We dropped below zero with the NYSE McClellan oscillator, so that's turning the summation index. It's really hard to see. We're just barely going down here based on price and volume for the summation index for the NYSE. And the Swindon Trading Oscillator declined based on price and volume, although we are still above zero and really not seeing much momentum at all. We were trying to turn back up with the slope oscillator, and if we do get above the moving average, we'll already be extreme positive. That's the green line here. We're actually a little more tame with the TSI, the other short-term oscillator, but we're coming down, back down to the moving average. And then our intermediate-term oscillators, we're drifting lower with the MACD. We're sideways coming back down to the moving average with the PMO and drifting lower with the PPO. This, in my opinion, is a little bit more concerning. We have the TRIX and KST, which are longer term oscillators, and they're still extreme positive, and they're starting to roll over and turn more negative. And we're seeing that globally as well. Pretty much all the stocks in the China, emerging markets, Europe, those are looking more negative. So we're also entering a weaker period of time. The second half of June tends to be negative when compared to the first half of June. So we'll just see. Is the market getting set to see more declines from here? And we're improving with the Copic curve, another momentum oscillator, but we haven't crossed above the moving average yet. We are negative with the smart money indicator here, the chicken money flow, where the histogram is declining and the 5-day moving average here is also starting to go down, the red line. And we were switched back to positive after Thursday. We dropped back and went negative after Friday with the Chaikin oscillator, another smart money indicator. And longer term, we're still positive on the daily side with the green line above the red line, even though we're not trending. Well, here we are trending, but it's a weakening trend since the ADX, the black line, is falling down below the moving average. And the red line is still above the green line, even though the red line's coming down as the green line's trying to come back up. But they haven't crossed positive yet. And we're just kind of chopping around right now with the bullish percent index. I have it on the negative side because of the down day on Friday, and we did decline just a little bit. Also a little bit of a decline with the NYSE bullish percent index, and still extreme positive and drifting, but now drifting lower with the NASDAQ 100 bullish percent index. We're still below this red line, which is a moving average of the special K. This is a long-term oscillator, which has yet to turn positive. We're still positive on the weekly chart, but we're negative here on the daily chart. And then no changes to the Zohar check, but we had been at a full 10, then we came down to 8, then 4, now we're down to 0. If we drop further down below 0, which would turn this negative, that would suggest a longer term negative outlook. And we drop below 50 with the 20 period moving average study and the 200 period moving average study, just barely. We're at 49.8. Where the 50 period and 100 period moving average studies are still above 50, back here with the 20 and the 200, they have dropped below 50. And this is a little bit of a concern. We're seeing a bit of a divergence here with the weighted version of the S&P, which is the bar chart, and the equal weighted version of the S&P, which is the red line. The S&P has been holding up a little bit better, and this just suggests that the rest of the stocks in the S&P are not holding up. Now, that's the negative side. The positive side is if the big stocks, the mega cap stocks, the Magnificent Seven, if they can keep the market going up and show some strength, it doesn't matter as much if this red line is actually going down. But when things are more positive in a broader scope, we tend to see the red line pretty close to the bar chart. And we're seeing that here too. With this ratio going up, that means the weighted version of the S&P is outperforming the equal weighted version. And we fell back down below the 200-day moving average with the Dow. So that's why this is negative. We're negative with the NASDAQ 100 momentum as measured by the PPO. And small caps, they're still well below their 200-day moving average. They had a good week last week. They started to go up. They got a little bit above this R1 resistance level and now have been coming back down. And we're seeing it here a little more plainly. This is another small cap index, the Russell 2000, where we came right up to the 200-day moving average. And now small caps have been retreating. And have not been able to get above the 200-day moving average with the mid caps. This just continues to act as overhead resistance, and now we're seeing a decline. And we drop back below the 200-day moving average with the bank ETF. So a little bit of weakness there. We're also seeing some weakness on a ratio basis with the financial sector to the S&P, even though the financial sector itself is still looking pretty good. Home construction continues to be negative. As I keep pointing out, we saw the weakness develop here in late 2024. That was giving us a heads up that all was not well with the market. And this ratio still continues to go down when we look at home construction to 3 to 7 year bonds. Semiconductors still in a downtrend. They're on the negative side because of that downtrend, but we could say it's positive because we're above both of the moving averages. Also, this is that same ETF, but we're still above the rainbow. I could have put this on the positive side, but this is such an important part. If semiconductors can outperform tech, and tech also is doing well, that really helps the market. And we're not seeing that on a consistent basis, at least yet. Here's another semiconductor index, which also we're above both of the moving averages here. And we're seeing a little bit of an improvement. What we're trying to see in this chart is the semiconductors, which is growth to Dow ratio. We've been seeing a series of lower highs here. It looks like we were finally trying to break out here, but we need to see more conviction and see this ratio really come up to be more positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then the areas that we're just watching. Now, weekly jobless claims, they're doing all right. We're still kind of within the higher end of this range. What caused the concern this week is we saw a big jump in continuing claims. These are folks that are unemployed for longer than just 1 week. And if this continues to go up, that's going to be a warning flag that maybe, okay, not all is well in the employment area. And that's been keeping us with this idea that maybe we won't go into a recession. Now, we'll just see. We want to look for overall trends, even though the moving average is still going up. We'll see in the upcoming week, are we going to see a continuation of higher readings here? And then we did see a bit of an improvement with the latest reading of individual investors. They actually came back a little bit above the zero line when you take the bullish versus bearish folks that take this survey, and it's slightly positive. And we're just watching this, the skew index. This is a variation of the VIX. We're getting close to this red area up here, and that's when we really start to pay attention to this chart. Now, we may turn and come back down and not go up into the red area, or if we do go up into the red area, we'll be watching this. It's hard to get some context with this chart because this doesn't necessarily mean we're going to have an upward move or a downward move. It just means the market's expecting some kind of a big move. And we are still below average with volume. That seems to be consistent. And then as we get deeper into the summer months, we're probably going to see volume remain below average unless something really big happens. And we're still watching the 10-year yield for right now. This is more positive because we're below this red line, which is the 4.5% level, even though interest rates did go up in Friday's session. And then we're just watching the interplay between bonds with each other, not really showing any inflation concerns right now when we look at the 1 month to 3 month T-bill versus the 3 to 7 years. If this was going up, that would mean the market's more concerned about interest rates and inflation going up. That same thing applies here with the tips to 3 to 7 year bonds, where this ratio is actually going down. And we're just kind of chopping around here with the tips to 7 to 10 year as well. And we just want to keep an eye on the spread between risky, like junk bonds, and not as risky bonds, like government bonds. We've seen this a little bit more tame right now. We're not really seeing a big decline in this, which would mean fear is starting to increase. And we did go inverted for 1 day this past week with the 10-year to the 3-month yield curve. We just want to keep an eye on that one. And the dollar continues to be negative, which could actually be positive for stocks. Stocks tend to like a weaker dollar. Oil, we're watching this. We had been in the upper 50s, and we started to creep back into the mid 60s with Friday's move up because of what's happening between Israel and Iran. Oil is really going up. We'll see if that continues to go up because Iran, they control the Strait of Hormuz, and they could block that, and that could really send oil prices going up. And we just want to keep an eye on the German DAX, which is coming off of setting recent all-time highs. It's a pretty strong index these days, but we are seeing an improvement when we look at U.S. stocks to German stocks on a ratio basis. But we've been kind of just chopping around here at lower levels after seeing a consistent decline. And then these are other areas we just want to keep an eye on. This top chart, this is the weighted discretionary versus the weighted staples ratio. Kind of chopping along recently sideways. Seeing a little bit of weakness here with the equal weighted version of discretionary to staples. We would like this to do a lot better than it's been doing. Kind of going sideways right now with tech, which is growth versus utilities. We would like to see more of an improvement here. A little bit of a pullback after improving when we look at biotech to healthcare. And a little bit more weakness when we look at hotels, which are discretionary, to utilities. We would like to see all of these continue to go back up. If they're going up, that would be much more healthy for the market. And then we keep an eye on what are called bellwether areas of the U.S. economy. Semiconductors, it'd be nice if they really started to improve. They were improving, but I've seen some recent weakness. Home builders, just at best, are kind of chopping sideways. Transport, seeing some weakness here. Retail, keeping an eye on that as well. It had been improving, now starting to pull back and go back into the range that it's been in. And the regional banks had been improving, but now coming back into their most recent range. This is another ratio between retail and the SPY. It just shows now for the last couple of years, 3 or 4 years, how retail has been underperforming the S&P. When we look at retail all by itself, it's coming back down to its 200-day moving average, and we're just slightly crossing below 50 with the RSI. So some weakness there. We're going to get retail sales this week. And we keep an eye on this ratio between gold and the SPY. We came right up to this trend line, and so far, this ratio has been backing off. That means that stocks have been outperforming gold. And we just look at U.S. versus international stocks. Now, going back to the beginning of February, we saw this ratio really coming down, and that's what this red line shows. But then since we started coming up from the April lows, we've pretty much been going sideways with this overall ratio. Seeing a little bit of weakness here with the momentum versus the SPY. And this held up better as stocks were going down. Now we're seeing some weakness coming into this ratio. And we're seeing overall declines here when we compare emerging markets with developed markets. And these are the pivot points for Monday's session. They've already been updated on the YouTube community tab, and they're also available on the website. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.